So yes, company can issue at enormous premium as well. So don't be confused that the value of 500,000, so value of shares are just 500,000 and then their premium is 9.95 million. Yes, it is possible, right? It's possible. So how we are going to represent this in our balance sheet? So here, company common stock are 500,000. So remember, we don't write authorized capital here. It is just for information. So they are authorized to issue only 10 billion shares. How many they have issued? Only 10 billion shares. 10 billion share value is 500,000. Paid in capital is this much. So their total paid in capital is going to be 100 million. And this is the retained earnings. So this is the total stockholder equity. Stockholder equity equal to paid in capital plus retained earning. Right? So this is how we make the entry. Now, no par value. When no par value, we don't have number of shares. That's it. So we have example here. If Apple Corporation issues 939 million shares of no par value at 16,422, entry would be cash to common stock. That's it. What is the value of one share? We don't write it. Why? Because there is no par value. Right? There is no par value. Value of the share can be increased or decreased, but we don't have any par value. Company doesn't mention that one share is worth of $10 or $0.05 or $5 or $100. Company doesn't mention that. Right? But this rarely happens. There are some companies who issued this, but it's rare. How we show that? Simple. Common stock, we write it down no par value. Right? So maximum they are authorized to issue 1,800 shares of no par value. They have issued 939 in millions, only 939. One share is equal to, you don't mention here, only say no par value. That's it. So it means there is no paid up capital here, right? Because we don't know that how much is the premium, right? In case when the company issued above the par, when par value is mentioned, then we have common stock plus paid in capital, then we have total paid in capital. Right? Here. Common stock plus paid in capital, we have total paid in capital. But if company issued the stock with no par, then there is no need of this account. So your common stock will be your total paid in capital. That's it. See, there is no paid in capital here. Now, up till now, what we have discussed? We have discussed issuance of share. That's it. For cash. But what if company don't have cash? Can they issue share? Yes. Answer is they can issue shares against assets. Okay. Let's talk about this illustration here. On November 12th, the Khan Corporation issued 1,500 shares of one par value for equipment of the market value of 4,000 and a building market value of 120,000. So how much is the value of 15,000 share? 124,000. Right? So company received total paid in capital gonna be 124,000. And remember, total paid up capital is equal to common stock plus paid in capital. So par value is 1. They have issued 15,000. So 15,000 going to be their common stock. So less 124,000, 109,000 is the premium on above stock. So paid in capital in excess of common stock. So remember, we don't call premium here because we are talking about stock, right? In bonds payable, we call this premium, but the treatment is same like premium, right? So company issued, company received, building increase 120,000, equipment increase 400,000. So instead of receiving cash, company received equipment and building. So equipment, building to common stock to paid in capital. Entry is balance, right? So question is, can company issue common stock or company issue stock without cash? Yes, against any asset. Entry would be like this, right? So can company issue stock with the services as well? Yes, you don't have the money right now, right? You paid us lawyer services, legal services, and we don't have cash, we will give you shares. Simple, right? So remember, if you provide some services for company, that is expense. If we pay for that one, expense to cash, but we don't have any cash, we will give them shares. That's it. So let's see the illustration here. Khan Corporation engaged an attorney. The attorney bills the corporation $25,000 for services and to accept 2,500 shares for 1 par value. So common stock worth value 2,500, but the service fees is 25,000. So paid in capital in excess of par is 22,500. So legal expense to common stocks to paid in capital. Simple, right? Any question? Marilyn, Ella, Nam, Pinyo?
No question.
No question. Okay, let's move forward. Now, treatment of preferred stock. So preferred stock, same entry like common stock, but in this case, we have a separate account for paid in capital in excess of par for preferred stock. If we are issuing preferred stock on premium, then we say that paid in capital in excess of par for preferred stock. That's it. And there can be issued for conversion feature. So, for example, after some time, we can convert our preferred stock into common stock. So those who are holding 1 preferred stock will be given, for example, 2 common stock. Then we need to make the entry, that's it. Decrease the preferred stock, increase the common stock. Increase in common stock, credit. Decrease in preferred stock, debit. So we can make the entry easily, right? So before going further, let's have a 5 minutes break. Let's have a 10 minutes break for tea break, and then we start from here. Okay? So see you after 10 minutes. Okay, we were talking about the treatment of preferred stock, and is the same entries are same as common stock, but instead of writing down like common stock to cash, cash to common stock, you just write cash to preferred stock. If there is in excess of par, then paid in capital in excess of par of preferred stock. So it can be converted into common stock. Entry, I already told you entry would be like this. We have illustration we will talk about over there. So what if we receive the convertibles? So convertible preferred stock for $1, 50,000 shares issued. So 50,000 shares for 50,000 shares multiplied by $1, answer is 50,000. So company issued shares which are convertible preferred stock. So cash to, just write it down, convertible preferred stock, simple. So when it is converted into common stock, so converted preferred stock to common stock at a rate of 6 to 5 to 1, which means 8,000 shares or of par 1 value common stock issued against 50,000 shares of common stock, which means those who are holding 6.25 of the preferred stock will be given 1 common stock, right? So 8,000 total common stock issues, shares are issued. So remember, against preferred stock, so we need to decrease the preferred stock. So preferred stock decrease because it's par value 1. So $1 multiplied by 50,000, answer is 50,000. So we decrease the convertible preferred stock. So decrease in owner's equity, debit. So convertible preferred stock to common stock, which is 8,000 or 1 value, and paid in capital in excess of par, common. The difference is 42,000. 42,000 is like just like a premium. Right? Understand, Marilyn, Ella?
Yes.
Okay, let's move forward. So, authorized, issued, and outstanding capital. Authorized, which I already told you, is maximum number of shares under company's charter. Issued, that company, how much number of shares from this authorized capital company has issued. And outstanding, how much shares are in the market with the shareholders. So it means there is one difference, and that is there are some shares that company buy back for itself. We call this treasury stocks. We call this treasury stock. So the difference between issued and outstanding is just treasury stock. Treasury stocks are those stocks which company buy its own shares back from the market. So company issued shares required by the company. So it's not like you are buying others company shares. That is investment in other company. That is short-term investment or long-term, depending on the nature. But if company buy back its own share, we call this treasury stock. The reason, maybe company need to give shares to the employees as a stock option, employee, so they buy back from market and give it to the employees. Or companies see that our shares are traded at lower price. What if we purchase our own shares and when the price go high and then we will sell it later? One purpose is profitability. The other purpose is why takeover. In order some other person to take over your company, he must acquire 51% share. If someone who holds 51% share, he can come and he can change the company management. He can acquire the company, or other company can swallow this company. We call this hostile takeover. So if this happens, so companies start buying its own shares so that the other potential competitors won't buy our shares, and at the end change our management and our business as well. Or to increase any